What's up, guys? It's Cash Flow Cart, and today we are talking about books. Okay, I'm not gonna kid myself and say that there's some magical book you can read that's going to, make you rich or give you all the tools to get wealthy. I'm not gonna be that guy, but I've read a lot of business books throughout the years, and I'd say one I read recently within the past, 6 months, I guess, really resonated with me. And I want to talk about the biggest lesson I took from that book. First off, I put life update on here. I don't really have much to talk about. Lately, I've been, working, chilling. It's summer, working out. I'll put life update because I want this to be like a conversational type of channel. But then again, if I don't really have anything to talk about other than stocks, I'm not going to force it. We do have a quick announcement for those of you that have been steady keeping up with the channel. We obviously hit the 60K goal in terms of total portfolio value, and now we are up to over 61,000. This says 2-year change right here, and it really bothers me because it's like 2-year change, only 10.15%. But that is not the case, guys. This is only since my TD Ameritrade account got moved to Schwab. So this 2-year change is really only since, May 13th. So we're up over 10% since May 13th. Awesome. Obviously, that's not really... I don't want to take that out of context because the market has been hitting all-time highs, the S&P 500 as well as the NASDAQ. So, there's going to be ebbs and flows in the account kind of with the market sometimes. And we can really only see that, total outperformance when we zoom out and get kind of, a year after year picture. That's when I'm going to aim for the performance. Nonetheless, I am happy with the portfolio's performance as of late. Since the Schwab move, it's been like steadily climbing. So I guess that is an announcement. We talk a lot about goal setting on this channel, and I do want to reemphasize, I do want to get to that $100,000 mark, as well as I want to get to the $3,000 mark in annual dividends. I don't know which one I'll get to first, and I think it's kind of going to depend on what the market does. If we see Apple and Microsoft continue to appreciate like they have been, certainly the 100K could come first. But I think the $3,000 mark in terms of annual dividends will most likely come first. That's my prediction. Oh well. So that's all we got today in terms of a life update and in terms of announcements. Let's get into it. I said we were talking about books today. The book we are talking about is called The Income Factory. Okay, this is a book by Stephen Bavaria, who is famous for, income investing, for spreading kind of his strategies and his take on things. And I'm not going to give you guys some spark notes or book review, but what I am going to do is take kind of the main lesson I took from this book, and I'm going to go ahead and go through, a couple different scenarios that kind of help drive this lesson home. So certainly, if you enjoy what I'm saying today, check out this book. I'm not even sure where my copy went. My parents are moving, or they just moved. So, a lot of stuff from my parents' house is now in storage or somewhere. I'm sure I'll find it again at some point, but it's a great book. Let's get into it. I'd say the biggest lesson from this book is this idea that, math is math. Okay? And that sounds kind of easily understandable, but I think a lot of investors struggle to kind of wrap their head around that idea because they're so caught up in, what the flashy securities are, what the market leading sectors are, and essentially they're kind of shooting themselves in the foot because they don't realize the point of this game is compound interest. okay? Compounding our wealth and, using a blend of securities that fits, our personal risk tolerance and our own diversification needs. It's not some magic stock that's going to 10x. It's not some, heaven forbid, cryptocurrency. It really is a game of math, okay? And I really want to drive that point home today. So we're going to walk through two scenarios. I've got this, dividend calculator tab pulled up twice. And, you guys have seen me use this before to kind of drive home points. And we are going to do just that today. I was thinking about using data from an actual stock that I own. However, I decided it might be a little better and more clear if I do like one conceptual stock versus another conceptual stock. We're going to leave out specific tickers and we're just going to focus on, two different types of stocks. So bear with me, guys. For stock A, we're going to say, this is a dividend stock yielding 5%, okay? We're going to start with $10,000 in the portfolio. And a dividend stock, like I said, yielding 5%, okay? A dividend growth stock. We're going to go ahead and assume that their annual dividend amount increase per year is 5%. And, with that being said, a stock yielding 5% that's also increasing the dividend 5% is most likely going to be in kind of a more mature phase of, the game. And with that in mind, we're going to put 5% here as the expected annual share price appreciation. That is a little lower than the S&P 500 has averaged over time, but we're going to keep it simple. 5% annual share price for stock A, the dividend stock. We're going to go with no annual contributions, and we are going to go tax exempt. Either you're doing this in a tax exempt account or you're paying taxes out of pockets. Just for simplicity's sake, we're going to go 0% tax rate. That's fine. Distribution frequency, we'll leave on annually, and we are going to reinvest dividends. That's what this DRIP stands for, Dividend Reinvestment Plan. Guys, my take is leave the cash in your portfolio, add new capital when you can, and use that new capital along with your dividends to continue building your portfolio. With that being said, I understand once your account gets to a certain size, you may have to take some dividends to cover living expenses, bills, whatever. Just don't get in the habit of always pulling out 100% of your dividends and, never investing new capital, because then that's going to, it's going to take a lot longer to get to where you're going in this game. Okay, so now let's move on to stock B. We're going to go with the same starting principle. Guys, stock B is not going to be a dividend stock. Okay, does that make sense? So we'll go 0% initial annual dividend yield, and we will go, 0% dividend increase because this is a non-dividend payer. This could be something like Tesla or Amazon, or a stock that doesn't pay a dividend that has, performed in pace with the S&P 500 in terms of share price appreciation. Okay, so we'll say 10% expected annual share price appreciation. And I do want to go over this real fast. What is the historical average for the S&P? In the last 10 years, it is 12.58%. We've had a pretty bullish market from 2014 until present day. Last 20 years, it's about 7.7% annually. And, up here, about 10% historically since its 1957 inception. Okay, so I like to use 10% for... I like to use 10% whenever I'm trying to model something on the long term, because, since inception, the S&P 500's average annualized return is roughly 10%. So that's where I got that number. Again, we've got stock A, the more mature dividend guy with a pretty good starting yield, a slower growth rate, and a little slower share price appreciation. And then we've got stock B that might be a little flashier, that might be kind of, leading the market's growth with that 10% annual share price appreciation, but they don't pay a dividend. Again, we're going to go 0 contributions. We're trying to keep things pretty simple today. We're going to go no taxes. And I mean, this doesn't really matter since we don't have any dividends to reinvest. And we are going to model this situation on a 20-year basis. What do you guys think is going to be better? Okay? So, I don't know if you're a newer investor and you have some sort of, idea about where wealth can be built, about what type of stock or security is the best at building wealth. But, let's go ahead and see what the numbers say. We'll hit calculate dividends, okay? So your dividend portfolio after 20 years, again, this is the dividend stock, okay? The 5% yield, the 5% growth, and the 5% share price appreciation. That ending balance starting from the $10,000 principal is going to be $67,275, guys. And now let's look at, the other guy, stock B. No dividend, still 20 years, but a little more aggressive share price appreciation. We'll go ahead and hit calculate. It's going to come out to, the exact same ending balance of that $67,275. And, going back to Stephen Bavaria's book, he does a really good job of, explaining this math is math concept. That's literally the verbiage he uses. He says math is math. And I think that was the best lesson I took from that book. He will go into, a couple different scenarios, a lot more in depth. He'll look at it using closed-end funds. He'll look at it using different tax brackets. And you'll get kind of this full picture if you read the whole book like I did. But I just wanted to kind of go through the main idea. And there is something I do want to bring up that kind of, suggest that the dividend stock A, is actually going to be, a better pick in the long run. Okay? So let's go back to stock A. Again, we're on our 20-year scenario. At this point, the annual dividend income from this is going to be $3,363.75. So, if you are at the point where, you want to retire, you want to pay bills, obviously this is not going to, $3,000 is not going to cover the cost of living in 20 years. But, obviously, hopefully you can invest more than $10,000 at some point, and you do make annual contributions. So after 20 years, this dividend portfolio will produce, over $3,000 in cash flow, which you can use to pay bills without depleting, your ending balance, without depleting your total portfolio value. Okay, does that make sense? But if we go back to stock B, obviously we said it wasn't a dividend payer. So, if we're taking kind of the retirement example, you're going to have to start depleting this balance, okay? You're going to have to start depleting this $67,000 to, pay your bills. Either that, or you're going to have to sell and kind of move this money into securities that do provide cash flow. And I think this is really important to point out because I notice, especially with a lot of newer investors, they get pretty hung up on, when's the entry on Tesla, when's the entry on Nvidia, something like that, where they're not really, they can't really wrap their head around this idea that you can build wealth using, a variety of different securities. And if you have, kind of a 20-year time frame, oftentimes the dividend growth route is going to be, it's going to be a better route for you. Not to mention, if we go back here to stock B, it's going to be pretty tough. It's going to be pretty tough for a stock to have an annual share price appreciation of 10% for 20 years. I mean, you're going to have to pick the correct security, or you're going to have to use kind of a SPY or an ETF like that, in which case you are going to be, paying a fee on top of that. Does that make sense? Which is going to further cut into your ending balance. Okay, so I hope kind of by walking through these two examples, my goal here was to build the case for dividend growth investing. And I really want you guys to kind of open your eyes to, okay, maybe dividend growth investing isn't the flashiest thing in the world, but if we sit here and we go through the math, you're probably going to end up in a better situation with dividend growth investing than a lot of other different strategies. Does that make sense? One other quick disclaimer I did want to, include in this video is right here. Expected annual dividend amount increase per year. I've put this in 5% for a 20-year time frame. Obviously, if you have any experience in this game, we do understand that this is a very unlikely case. Oftentimes, over the course of 20 years, a lot of dividend payers typically slow down. They typically slow down the rate at which they increase their dividend as they kind of make that shift from the earlier phases of the company to, the more mature value play. Typically what's going to happen is this number will slow down. And we've talked about this before. Let's look at Altria real fast. So oftentimes, I don't want to say a phenomenon because it's almost common sense. So oftentimes we've talked about, if we do see a company with this great track record that can be very attractive to us dividend growth investors, we like to see a company that has a proven history, that has a staying power, and that has kind of a real commitment to shareholders to continue to pay a dividend. A lot of times I kind of look at the investor relations on their website, and I try to see, what they talk about in terms of their dividend and their commitment to investors. But if we do see kind of a longer track record here, like in Altria's case, 54 years, we often see the growth rate of that dividend, kind of decreasing. Altria's is 4.14. For sake of consistency, we'll also look at Hershey. I feel like we've been using these two companies a lot lately for teaching, but I like to talk about whatever companies are kind of on my mind, at the top of mind. Hershey has only grown their dividend for 14 years as compared to Altria's 54, but their 5-year growth rate is 12.15%. Okay? By the time Hershey gets to that 54-year, dividend growth rate, hopefully I'm still here posting on YouTube in 40 years. By the time they get there, this number, it is very unlikely that it will be 12.15%. So again, these are just kind of strictly theoretical cases, but I did want to include kind of those disclaimers, guys. So again, this is Cash Flow Cart, and if you tuned into the video today, guys, thank you so much. I feel like this video was a little more laid back, kind of a book recommendation video, if you will. And again, Stephen Bavaria can definitely go much more in depth into these concepts and look at it from a whole, a variety of different angles, a variety of risk tolerances, if you will. And if you want to hear more about this, I guess, definitely check out his book. One more disclaimer I do want to include. Guys, when you're reading books, specifically finance books, or I don't know if you guys are ever into self-help books, any book that, you're reading with kind of an expectation of, this could help me in life, I guess, not just a pure entertainment type book. Make sure you're not getting so caught up and so bought into what the author is saying. In my opinion, guys, the only real way to go about this game is to experience it for yourself, to understand yourself as an investor. And if a book helps you kind of, see different strategies, and you can pick, one or two things that really resonate with you, that's the approach I want you to take to reading this book. I don't want you to think that reading one book will somehow give you all the tools to build wealth. But that's just a quick 2 cents, guys. Again, I will see you next Monday. This is Cashflow Cart. Let's build wealth.